Hey there, welcome back for another deep dive. Today, we're tackling momentum in technical analysis.
Okay.
We've got selections from Michael C.,
Yeah.
Tom Zitt's book on the topic.
Right.
And trust me, this could change how you see the markets moving forward.
It's a fascinating area because it challenges some very fundamental assumptions about how prices behave.
Right. So before we get into momentum itself, let's make sure everyone's on the same page about technical analysis.
Essentially, it's looking for clues about future price movements by studying the charts, things like past prices and how much trading volume there's been.
Okay.
Instead of focusing on a company's fundamentals, you're trying to identify patterns and signals in the price action itself.
Like a detective of the markets looking for fingerprints and footprints.
Right.
But our source material mentions this isn't exactly foolproof. There's debate about whether technical analysis reliably works.
Sure.
What's your take?
There are definitely different schools of thought.
Okay.
Some people are skeptical, pointing to ideas like the efficient market hypothesis, which argues that all public information is already factored into a stock's price.
Oh.
So, good luck finding an edge.
So it's like saying everything that's knowable is already known,
Right.
so why bother?
Exactly. Then you've got the random walk hypothesis, which suggests short-term price movements are essentially random, like flipping a coin.
If it's all random, why analyze anything?
Right. But this is where momentum gets interesting.
Okay.
This book argues it can challenge those very notions.
Okay.
What if the market isn't always perfectly efficient? What if those seemingly random price movements hold clues to something deeper?
Okay, I'm intrigued.
So let's talk about this momentum thing.
Sure.
The author keeps saying it measures the strength and speed of price changes, but not the direction.
Right.
Why is that distinction so important?
Think of it like the speedometer in your car.
Okay.
It tells you how fast you're going, but not if you're headed to the beach or back home.
I get that, but why is just knowing the speed helpful if you don't know where you're going?
Because a sudden acceleration or slam on the brakes, regardless of direction, tells you something is up.
Okay.
It could mean the market's getting overly excited or that a trend's losing steam even if the price hasn't fully reacted yet.
I like that. It's like a gut check on market sentiment. Are things getting out of hand, or are we cruising steadily? Speaking of getting out of hand, the book talks about overbought and oversold conditions.
It's like the market itself gets tired out.
Exactly. Just like you can't sprint forever, a stock can't go straight up or down indefinitely.
Right.
Overbought suggests the price has risen too quickly, making a pullback likely, while oversold suggests the opposite, it might be due for a bounce.
So these are warning signs that the current trend might be running out of steam.
Precisely. And the book dives into some specific tools called oscillators that help us measure momentum and spot those potential turning points.
Okay, let's get into the specifics. The book focuses on 5 key momentum oscillators.
Yeah.
The RSI, MACD, rate of change, stochastics, and Bollinger Bands. I know those sound intimidating,
Sure.
but stick with us. They're not as complex as they seem.
They each have their strengths and weaknesses, but together they can provide a powerful framework for understanding momentum.
Let's start with the first one, the RSI. What's the deal with this one?
The Relative Strength Index, or RSI, is great for beginners because it's fairly straightforward. It looks at the average gains and losses of a stock over a set period, typically 14 days, and plots them on a scale of 0 to 100.
So higher RSI means stronger momentum.
Generally, yes. A reading above 70 is usually considered overbought, suggesting the price might be getting ahead of itself. Below 30 is oversold, signaling a potential bounce.
So it's like a traffic light system for momentum.
Okay,
Green light below 30, yellow light above 70, proceed with caution.
that's a good way to think about it. It's all about identifying those extremes and being aware of potential shifts in momentum.
But are there times when these RSI signals can be misleading?
You're right to be cautious because no indicator is foolproof. Take, for example, a stock that has a big earnings surprise. Let's say the company's profits are much better than anyone expected.
That's good news. The price should go up, right?
You'd think so, and in this example from the book, it did initially.
Okay,
But then something interesting happened.
that happened.
After that initial surge, the RSI suddenly plummeted, dipping down into oversold territory.
Wait, what? Good news should mean continued upward momentum, shouldn't it?
It seems counterintuitive, but that's where understanding momentum can give you an edge. The market doesn't always move in a straight line. Sometimes it overreacts.
So even with good news, momentum indicators can help you avoid getting caught up in the hype and potentially buying at a bad time.
Precisely. It's about recognizing that the market has a tendency to get ahead of itself sometimes.
That makes a lot of sense. So the RSI helps us see those potential overreactions, even when the news seems overwhelmingly positive.
Exactly. It's about looking beyond the surface and understanding the forces driving the price action.
Okay, I'm starting to see the value here.
Yeah.
So we've got the RSI for a big picture view of overbought and oversold conditions. Now let's move on to another one of these oscillators, the MACD. This one always seemed a bit like a secret code to me, but I'm ready to crack it.
The MACD, which stands for Moving Average Convergence Divergence, sounds complicated, but it builds upon the concepts we've already discussed.
Building upon them how? It seems completely different to me.
Well, at its core, the MACD is trying to spot potential changes in momentum by looking at the relationships between different moving averages.
Okay, quick refresher. What are moving averages again?
Moving averages are simply the average price of a stock over a set number of periods. For example, a 20-day moving average would be the average closing price for the past 20 trading days.
Right, right. Averaging prices smooths out the daily noise so we can see the bigger trend. So how does the MACD use them?
It looks at the difference between a 12-day exponential moving average, or EMA, and a 26-day EMA.
Exponential.
It means it gives more weight to recent prices, so it's more sensitive to changes than a simple moving average.
Got it. So is the MACD just telling us when those two moving averages cross each other? What's the big deal with that?
It's more than just the crossovers, though those can be significant. Remember how we talked about divergence with the RSI? Well, the MACD can also show divergence, which can be a powerful signal.
Right, divergence when the momentum indicator is telling a different story than the price action. So how does that work with the MACD?
Let's say a stock is making lower lows, but the MACD is making higher lows.
Okay, so the price is weakening, but the momentum indicator is actually showing some underlying strength. Is that what makes it divergent?
Exactly. That's bullish divergence, and it often suggests the selling pressure might be drying up and a reversal could be on the way.
So, like, hidden strength that isn't reflected in the price yet.
Yeah.
And I'm guessing there's bearish divergence too.
Absolutely. Bearish divergence would be the opposite. The price making higher highs, but the MACD making lower highs. This could mean the rally is losing steam, even if the price is still climbing.
Got it. The MACD can alert us to those times when the momentum behind a trend might be changing, even if the price hasn't fully caught up yet.
You're getting it. It's like getting a sneak peek at what's really driving the market under the surface.
I like that. Speaking of looking under the surface, how reliable is the MACD? Are there times when it can give false signals?
You always have to be cautious because no indicator is perfect. It's important to remember that the MACD relies on relatively short-term moving averages, which can make it susceptible to short-term noise and volatility.
So maybe not the best tool for long-term investors who are trying to ride out the ups and downs.
Probably not. The MACD is likely more valuable for shorter-term traders who are trying to capitalize on those swings in momentum. For long-term investors, other indicators might be more informative.
Okay, makes sense. It's all about choosing the right tool for the job. So we've got the RSI, which gives us a big picture view of overbought and oversold conditions, and the MACD, which helps us spot shorter-term shifts in momentum. What about this rate of change oscillator? What's that one all about?
The rate of change, or ROC, is a bit simpler than the MACD, but can be a useful addition to your toolkit. As the name suggests, it measures the percentage change in price over a specific period.
So like how much the price has moved up or down in the past week or month or whatever period you set it to?
Exactly. The most common setting is 12 periods, but you can adjust it depending on your trading style.
And how do we interpret the ROC? Is there a magic number to look for?
Unlike the RSI, which has those clear overbought and oversold levels, the ROC is more about looking at the trend of the indicator itself. Is it moving up, down, or sideways? Is it accelerating or decelerating? Those are the clues you're looking for.
So a rising ROC means the price is gaining momentum, and a falling ROC means it's losing steam. Sounds simple enough.
It is, and it can be very helpful for confirming what you're seeing in other indicators.
Yeah.
For example, if you see a bullish price pattern forming and the ROC is also rising, that adds weight to the idea that the move might have legs.
Right, confirmation. We're always looking for multiple signals to line up before making a move. What about divergence? Can the ROC show divergence like the MACD?
Absolutely. Let's say the price is trending upward, but the ROC is starting to turn down. That could be a warning sign that the rally might be running out of steam, even as the price continues to climb.
So it's like the ROC is giving us an early warning that the momentum might be shifting even before we see it in the price action.
Precisely. It's all about those subtle cues and how they can help us anticipate potential turning points.
This is great stuff. Okay, so we've covered the RSI, MCD, and the ROC. Up next, we've got stochastics, which always sounded a bit random to me.
The stochastics oscillator is anything but random. It's actually quite clever in the way it looks at momentum.
Okay, I'm intrigued. Tell me more.
The stochastics oscillator focuses on where the closing price of a stock falls within its recent trading range.
So is it closing near its highs or its lows? Why is that significant?
The idea is that if a stock is consistently closing near its highs, that suggests strong buying pressure and bullish momentum. Conversely, if it's closing near its lows, that could be a sign of weakness.
Makes sense. So how is this plotted on a chart?
The stochastics oscillator is plotted on a scale from 0 to 100. Just like the RSI, readings above 80 are generally considered overbought, and readings below 20 are considered oversold.
Okay, so similar to the RSI in terms of how we interpret those extreme readings.
Yes, but there are some key differences. The stochastics oscillator is often more sensitive than the RSI, so it tends to generate more signals.
More signals could be a good thing or a bad thing, I suppose.
Exactly. It can be helpful for spotting potential turning points earlier, but it also means there's a higher chance of false signal.
Right, false signals, that's always the challenge with technical analysis. We have to be careful not to chase every little wiggle.
Absolutely. Confirmation is key. The book gives an example of a stock where the stochastics oscillator dipped into oversold territory and then quickly reversed back up.
So a classic buy signal.
It appeared to be, but then the price continued to drift sideways for a while before finally breaking out to the upside.
So the stochastics oscillator gave an early warning, but it took a while for the price action to confirm the signal. Patience really is a virtue when it comes to trading.
Indeed. And that example highlights the importance of looking at other indicators in conjunction with the stochastics oscillator. Don't rely on it in isolation.
Got it. So the stochastics oscillator can be a helpful tool for spotting potential turning points early on, but we need to be extra careful about confirmation and not jumping the gun. Now let's talk about the last oscillator in our lineup, Bollinger Bands. I'll be honest, this one has always intimidated me a bit. It just looks so much more complex than the others.
I get it. They can seem that way at first glance. The Bollinger Bands definitely stand out on a chart, but the underlying concept isn't as complicated as you might think.
Okay, good. Demystify the Bollinger Bands for me.
At their core, Bollinger Bands are all about measuring volatility.
Volatility meaning how much the price is moving up and down?
Exactly. You've got a middle band, which is a simple moving average, usually 20 days. Then you've got two outer bands plotted 2 standard deviations away from that middle band.
Standard deviations. Getting a bit statistical here, but I think I get the basic idea. The outer bands expand and contract based on how volatile the stock is.
Precisely. When the stock is making big moves up and down, the bands widen. When things are relatively calm, the bands contract.
So how do we actually use this information to make trading decisions?
Bollinger Bands are great for identifying potential turning points and spotting those times when a stock might be stretched too far in one direction.
Stretch too far, meaning overbought or oversold.
Think of it more like a rubber band. When the price moves outside the outer bands, it's like stretching that rubber band. Eventually, something has to give, and the price is likely to snap back towards the middle band.
So if we see the price break above the upper band, that could be a sign that the move is getting overextended and a pullback could be coming.
Exactly. And conversely, if the price drops below the lower band, that could signal a bounce.
Okay, I see the logic here. It's like the Bollinger Bands are giving us a visual representation of the boundaries of normal price movement for that particular stock.
That's a great way to think about it. The further the price moves away from the middle band, the more likely it is to eventually revert back towards the average.
And because the bands adjust based on volatility, they're always giving us an updated view of what's normal for that stock at that moment in time.
Precisely. The Bollinger Bands are dynamic, so they can adapt to changing market conditions.
Very cool. And
Exactly. And there are even more nuanced signals within the Bollinger Bands themselves. For example, the book mentions a pattern called a Bollinger Band squeeze.
a squeeze, what's that all about?
A squeeze happens when the bands contract significantly, indicating a period of low volatility.
So the market's getting quiet, almost like it's holding its breath.
Exactly. And often, a squeeze is followed by a breakout in one direction or another.
So it's like the market's coiling up, getting ready to spring. The Bollinger Bands can help us anticipate those big moves before they happen.
You're catching on. And another interesting aspect of the Bollinger Bands is that they can be used to identify dynamic support and resistance levels.
Dynamic, meaning they change over time, unlike those straight horizontal lines we often see on charts.
Exactly. The outer bands can act as dynamic support and resistance levels, giving us a more flexible and responsive view of where the price might find buyers or sellers.
Okay, this is fascinating. It seems like the Bollinger Bands can be used in so many different ways to gain insights into market behavior. I'm starting to think they're not as intimidating as I initially thought.
They're definitely worth mastering. And don't forget, the key is to use them in conjunction with other indicators and to always confirm your signals.
Confirmation, confirmation, confirmation. I'm starting to sound like a broken record, but it's really the golden rule of technical analysis, isn't it?
Absolutely. No single indicator is infallible, but by combining different tools and perspectives, we can increase our chances of making well-informed trading decisions.
So we've now covered all 5 of these momentum oscillators. The RSI, the NCD, the rate of change, stochastics, and the Bollinger Bands. They're all unique in their own ways, but they all share this common goal of helping us understand the forces behind price movements.
And as we've discussed, it's all about context and confirmation. No indicator is a magic bullet, but by using them together and understanding their limitations, we can gain a deeper understanding of market dynamics.
Absolutely. This has been a great deep dive into the world of momentum oscillators. But before we wrap up, the book also mentions how these indicators can be used to spot both reversal and continuation signals. It seems like most traders are laser focused on reversals, but continuation is just as important, right?
You're right. While everyone dreams of catching that perfect reversal, understanding continuation signals can be just as valuable, especially if you're looking to ride trends for longer gains.
Okay, so let's unpack this a bit. We've talked about how oscillators can signal potential reversals, especially when they move into those overbought or oversold zones. But how do they help us spot continuation?
It's actually pretty simple. With continuation, you're often looking for what doesn't happen with the oscillators.
What doesn't happen? That sounds a little cryptic.
Think about it this way. If a price trend is strong and likely to continue, you wouldn't necessarily expect to see the oscillators screaming overbought or oversold, right?
Okay, that makes sense. If the momentum is healthy and sustainable, the oscillators should be behaving themselves, staying within those normal ranges.
Exactly. So in many cases, the lack of extreme readings on the oscillators can actually be a signal of continuation.
Interesting. So it's not always about those big, flashy overbought or oversold signals. Sometimes the more subtle cues are just as important.
Exactly. And this book gives some great examples of how to combine momentum oscillators with other indicators like price patterns and volume to confirm both reversal and continuation signals.
I'm starting to see how much depth there is to this world of technical analysis. It's not just about finding the holy grail indicator, it's about understanding the language of the market and how different signals interact with each other.
That's a great way to put it. It's about becoming fluent in the language of charts and indicators and then using that knowledge to make more informed decisions.
Okay, I think we're ready to move on to part 2 of this deep dive into momentum. We've laid a lot of groundwork here, but there's still so much more to uncover. All right, so we're back and ready to dig deeper into momentum. You know, those classic charts with the lines crossing and everyone saying buy here or sell there. Well, we're going to talk about how momentum indicators play into that.
It's all about adding context to those signals. Traders often focus on moving average crossovers, especially the 50-day and 200-day ones.
Right.
But those can be lagging indicators.
Lagging meaning they're telling you what already happened,
Right.
not necessarily what's about to happen.
Exactly. By the time those longer-term moving averages cross, the move might be well underway, and you risk jumping in at a less than ideal time. That's where momentum oscillators can be incredibly useful.
So it's like they give you a second opinion. A way to confirm if the moving average crossover is a signal worth acting on.
Precisely. Let's say the shorter-term 50-day moving average crosses above the longer-term 200-day moving average. That's a classic bullish signal.
Bullish, meaning the price is likely to keep moving higher.
Right, but before you buy a ton of stock, you'd want to consult those momentum oscillators. Are they confirming the signal? For example, is the RSI trending upwards, but not so high, it's in that overbought zone? If it is, that adds weight to the idea that the move could have legs and you might have a good entry point.
Okay, so it's like the momentum oscillators are giving us that extra layer of confidence.
Right.
They help us separate the head fake moves from the ones with real momentum behind them.
Exactly. They're providing additional context and helping us gauge the strength of the move. And the same logic applies in the opposite direction. If we see a bearish crossover between those moving averages,
Okay.
meaning the 50-day crosses below the 200-day,
Right.
but the momentum oscillators aren't confirming the signal, that's a warning sign.
So even though the moving averages are suggesting a downtrend, The momentum oscillators might be saying, hold on, not so fast.
Exactly. It could be a sign that the selling pressure is weak and the move might not have much follow through. It might even be a bull trap.
Okay, so momentum oscillators can either add conviction to a moving average crossover signal or wave a red flag. It's like having a co-pilot in the cockpit, double-checking everything.
That's a great analogy, and the more tools we have at our disposal to analyze the market, the better equipped we are to navigate its twists and turns.
This has been eye-opening. I'm starting to see how understanding momentum can really take your technical analysis to the next level. It's not just about spotting overbought and oversold conditions. It's about using these oscillators to understand the nuances of trend strength, confirmation, and divergence.
Absolutely. Momentum is like having X-ray vision for the market. It allows you to look beneath the surface and understand the forces that are driving price action. And like any skill, the more you practice and study, the sharper those instincts become.
Speaking of practice, let's revisit some of those specific oscillators we talked about earlier. I think seeing them in action, especially in the context of these moving average crossovers, will really solidify these concepts.
Great idea. Let's start with the RSI. Remember how we talked about it measuring the magnitude of recent price changes and plotting them on a scale from 0 to 100?
Yep. With 70 and above generally signaling overbought conditions and 30 and below suggesting oversold.
Exactly. Now let's imagine we're looking at a chart where the price has been trending downwards for several months. We see the 50-day moving average cross below the 200-day moving average, a classic bearish signal. But then,
Hold on, let me guess. The RSI doesn't plummet down below 30 as we might expect. Instead, it starts to tick upwards, maybe even hovering around the 50 low.
you got it. That's a potential red flag. It suggests that even though the longer-term trend might still be bearish, the selling pressure could be easing.
So the RSI is giving us an early warning that the downtrend might be losing steam, even though the moving averages haven't caught up yet.
Exactly, and this is where things get really interesting. If we then see the price start to make higher lows, even as the moving averages are still trending downwards, that's even more evidence that the momentum might be shifting.
It's like the market is hinting at a potential reversal, but it's not quite ready to show its hand just yet.
Precisely. And this is where combining momentum oscillators with other indicators like price patterns and volume becomes so crucial.
Because no single indicator tells the whole story, right?
Exactly. It's all about piecing together the clues and building a compelling case for or against a trade. So in this scenario, if we see increasing volume accompanying those higher lows, that's even more evidence that the bulls might be starting to regain control.
This is incredible. It's like putting together a puzzle, but instead of a picture, we're trying to decipher the future direction of the market. Okay, so we've seen how the RSI can provide valuable insights when used in conjunction with moving average crossovers.
Yeah.
What about the MACD? How does that come into play?
The MACD can be particularly helpful for confirming the strength of a move following a moving average crossover. Remember, it's all about the relationship between those two exponential moving averages and whether they are converging or diverging.
Converging meaning getting closer together, and diverging meaning moving further apart.
Yeah.
And we want to see divergence from the price action, right?
Exactly. So let's say we're looking at a chart where the 50-day moving average has just crossed above the 200-day moving average, signaling a potential bullish trend change.
Bullish, meaning we might want to hop on board for the ride upwards.
But first, let's consult the MACD. If the MACD is also above its signal line, and we're seeing expanding bars on the MACD histogram, that's a very bullish confirmation signal.
Expanding bars, meaning the momentum is increasing, right?
Yeah.
It's not just about the crossover itself, but also about the force behind it.
You nailed it. That's what we're looking for. Confirmation that the bulls are really in control and this move has legs. Conversely, if the MACD is lagging, or we see contracting bars on the histogram, that's a warning sign that the bullish momentum might not be as strong as the moving average crossover suggests.
So just because the moving averages have crossed, it doesn't necessarily mean we should back up the truck. The MACD helps us fine-tune our entry and exit points.
Precisely. And that's the beauty of technical analysis. It's not about following any one indicator blindly, but about using multiple tools to paint a clearer picture of what's really happening in the market.
I'm loving this. Okay, what about the rate of change? How does that fit into this puzzle?
The rate of change, or ROC, can be especially useful for spotting those explosive moves that often follow a moving average crossover. Remember, the ROC measures the speed at which the price is changing over a specified period.
So the steeper the ROC line is angled, the stronger the momentum.
Exactly. So let's say we see a stock break out above a long-term downtrend line.
Meaning it's been in a downtrend for a while, but it's finally starting to show signs of life.
Right. And then, to confirm that the breakout has legs, We see the 50-day moving average cross above the 200-day moving average. That's bullish, but what we really want to see is the ROC surging higher as well.
Like a rocket ship taking off.
Exactly. That's the type of confirmation that tells us this move has serious momentum behind it, and we might want to consider jumping on board. Of course, we always want to be mindful of potential overbought conditions, so keep an eye on the RSI as well.
Got it. So we're looking for that confluence of signals, the moving average crossover, a surging ROC, and ideally the RSI confirming that we're not in overbought territory yet.
You're getting it. It's all about finding those high probability setups where all the stars align.
Okay, I'm definitely starting to feel like a momentum detective.
Sure.
What about stochastics? How can that oscillator add to our analysis of moving average crossovers?
Stochastics can be particularly insightful when we're trying to anticipate those times when a moving average crossover might be imminent.
Imminent, meaning about to happen. So we're talking about using stochastics as a leading indicator.
Exactly. Remember how we talked about how stochastics focuses on where the closing price falls within the recent trading range? Well, let's imagine a scenario where the price has been in a prolonged downtrend.
So the 50-day moving average is well below the 200-day moving average, and it seems like there's no end in sight to the selling pressure.
Right, but then we start to see some subtle shifts in momentum. Maybe the price starts making higher lows, and we notice that the stochastics oscillator is consistently making higher lows as well.
So even though the price is still in that downtrend, the stochastics oscillator is hinting at a potential shift in momentum.
Precisely. It suggests that the bears might be losing their grip and the bulls could be quietly gaining strength. If we then see the stochastics oscillator climb above its signal line and start to trend upwards.
That could be a sign that a bullish crossover of those moving averages is on the horizon.
Exactly. It's like
Yeah.
the calm before the storm. The stochastics oscillator, with its focus on closing prices, can often pick up on those subtle shifts in momentum before they're reflected in the longer-term moving averages.
That's incredible. It's like having a crystal ball.
Yeah.
Okay, so we've covered 4 out of the 5 oscillators. We've saved the best for last. Bollinger Bands. These have always fascinated me, but I'll admit I'm still wrapping my head around how to use them effectively, especially when it comes to moving average crossovers.
Bollinger Bands are incredibly versatile, and one of their most powerful applications is their ability to visually represent volatility and potential price targets following moving average crossover.
Okay, I'm intrigued. Tell me more.
Let's say, for example, that we're looking at a stock that's been trading in a tight range for an extended period. The Bollinger Bands are relatively narrow, reflecting that low volatility environment, and then, bam, we get a decisive breakout above the upper band, accompanied by a bullish crossover of the 50-day and 200-day moving averages.
Okay, that sounds like a pretty bullish setup already.
It is. But here's where Bollinger Bands can really shine. Remember how the width of the bands reflects volatility? Well, that upper band can often act as a price target following a breakout.
So you're saying that after a breakout, the price might continue to run until it hits the upper Bollinger Band.
Exactly. It's not foolproof, of course, but it's a common pattern that you'll see play out time and time again in the markets.
This is amazing.
Yeah.
So not only can Bollinger Bands help us identify potential breakouts, but they can also give us insights into how far those breakouts might run.
Precisely. And the same logic applies in reverse. If we see a breakdown below the lower Bollinger Band, accompanied by a bearish crossover of those moving averages, that lower band can often act as a downside price target.
Wow, this is powerful stuff. It's like having a roadmap for volatility. This is all starting to click now.
I'm glad to hear that.
This deep dive has been incredibly insightful. We've covered so much ground, but I feel like there's always more to learn. We'll definitely have to revisit this topic again soon.
I agree. Momentum is a fascinating and constantly evolving area of study. But for now, I think we've given our listeners a solid foundation for understanding how these powerful indicators can be used to gain an edge in the markets.
All right, we're back, and I'm still buzzing from all these momentum insights. We've covered so much ground already, but I feel like we've just scratched the surface.
There's always more to explore. Momentum is a key concept, but remember, it's not about blindly following any single indicator.
Right. Context is king. We've talked about overbought, oversold levels, divergence, confirmation from price patterns and volume, and even those dynamic support and resistance levels with Bollinger Bands.
It's like assembling a puzzle. Each piece gives you a clearer picture of the bigger market story.
Exactly. And speaking of putting the pieces together, what about those times when different momentum indicators give conflicting signals? How do you sort through that?
That's where experience and a well-defined trading plan become crucial. There's no single right answer, as it often depends on your individual risk tolerance, trading style, and the specific asset you're analyzing.
So it's not like one indicator always overrides the others.
Not necessarily. Sometimes one indicator might carry more weight depending on the context. For example, if you're a long-term investor primarily focused on those major trend changes, you might give more weight to the longer-term moving average crossovers and look to the momentum oscillators for confirmation.
So if you see a bullish crossover of the 50-day and 200-day moving averages, but the RSI is showing extremely overbought conditions, you might proceed with a bit more caution.
Exactly. It doesn't necessarily mean you abandon the trade idea altogether, but it's a signal to perhaps wait for a pullback or look for additional confirmation from other indicators before going all in.
Makes sense. It's like having a system of checks and balances to make sure you're not getting swept up in the heat of the moment.
Precisely. On the other hand, if you're a shorter-term trader, you might be more focused on those quicker swings in momentum and therefore give more weight to oscillators like the MESI-D or stochastics, which tend to be more sensitive to short-term price fluctuations.
So it's all about tailoring your approach to your specific trading style and goals.
Exactly. There's no one-size-fits-all approach to technical analysis. It's about finding what works best for you and developing a consistent process for analyzing the markets.
Consistency is key. I think that's something that often gets overlooked. It's easy to get distracted by the latest shiny object in the trading world, but ultimately it's about having a system you trust and executing it consistently.
Couldn't agree more. It's like any skill mastery comes from practice, discipline, and continuous learning.
Well said. This entire deep dive has been a masterclass in momentum, and I feel like I've gained so many valuable insights. But before we wrap up, I want to circle back to something we touched upon earlier, the idea of continuation signals and how they can help us ride those longer-term trends.
Absolutely. Continuation signals are often overlooked, but they can be incredibly powerful, especially if you have the patience to let your winners run.
So let's say we're looking at a stock that's in a strong uptrend. The 50-day moving average is above the 200-day moving average, and the price is making a series of higher highs and higher lows. How can momentum oscillators help us confirm that the uptrend is likely to continue?
One classic continuation pattern you'll often see is when the price pulls back slightly towards the 50-day moving average, but doesn't break below it. It's like the stock is taking a breather, gathering strength for the next leg higher.
Okay, so we're looking for that pullback to be shallow and contained, almost like a pause that refreshes.
Exactly. And here's where momentum oscillators come in. During that pullback, keep a close eye on the RSI. If the RSI dips down towards the 50 level, but then quickly reverses back upwards without ever dipping into oversold territory.
That's a bullish sign, right? It suggests that the selling pressure during the pullback was weak, and the bulls are still in control.
Precisely. And you might see a similar pattern with the MACD. Maybe the MACD histogram shows contracting bars during the pullback, but then quickly expands again as the price starts to rally. That's another clue that the uptrend is likely to resume.
So it's not just about looking for the big, flashy signals. Sometimes it's about those subtle cues that tell us the underlying momentum is still strong.
Absolutely. And don't forget about the importance of volume. If you see increasing volume accompanying that rally after the pullback, that's even more confirmation that the uptrend is likely to continue.
This is incredible. I'm starting to see how all these different indicators can work together to give us a more complete picture of what's happening in the market.
Exactly. It's like becoming a market detective, learning to read the clues and interpret the evidence.
And just like any good detective, we need to be constantly honing our skills and expanding our knowledge.
Absolutely. The market is always evolving, which means our learning never stops.
That's what makes it so exciting. This has been an incredible deep dive into the world of momentum. I feel like I have a whole new set of tools and perspectives to apply to my analysis. Thanks for joining me on this journey.
It's been my pleasure.